Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
The green light comes on. Hello? Okay, great. So thanks for coming. As announced before, today we welcome Mr. David Nolan from Point72, who was at Goldman Sachs for 25 years previously, and we thank him for taking the time out of his very busy schedule to share his wealth of information with us. So what will happen is that he's going to start with his prepared presentation with the slides that you saw already last night on Waddle. And then he's going to open up the floor to answer questions. And I really encourage you to take the opportunity to ask lots of questions. He's a wonderful person to talk to, and he's just so encouraging. So I hope you enjoy the next few hours. And let's welcome David.
Wow, this is a big theatre. Okay, so thank you for the opportunity. Wow, someone right up the back. Hello. If you feel that you want to interrupt me, you can. If you feel you want to ask questions, you can. We've got plenty of time. But I tend to talk a lot, so if anyone falls asleep, person next to them put their hand up and let me know that I've been talking too much. But anyway, so I've been doing these these guest lectures for a few years now, and I'm not saying that I'm good at them, but I try to leave a few messages, and each year I try to make it a little different. I realise none of you were in last year's lecture, or I assume none of you were. Sorry if you came in here a second time. But today I wanted to talk about a couple of things, but one of them is I want to talk about history a little bit. And I know right now you're thinking, old guy talking about history, yeah. But it matters in financial markets, and I'll try and explain why. I want to talk about the opportunity set. So some of the stuff's pretty basic, but I don't know your level of knowledge. And I know that you all have one thing in common, and the one thing in common is you all want to get a job. And so when we open to questions, if you say to me, I've got 3 distinctions, 4 credits, and my GPA is X, will I get a job? I'll be like, I don't know. But if you can ask me any other general question, what do I think? Because at the end of the day, what I'm trying to do is make you enthusiastic about financial markets. Last year I would have said I'm being enthusiastic about Goldman Sachs. Now I'm working on what's called the buy side, and I'll talk a little bit about that. But I understand that this is your main desire, and so I'm happy to ask questions. And the other rule, which is the last slide, I'm preempting my last slide, but there are no dumb questions. Some of you I've met already today, and I've said that and I'll say it again. And even if someone asks the same question but you didn't really understand the answer, you can ask the same question again. And just as a piece of general advice, excuse me, when you do get a job, there are no dumb questions. And if you work for someone who abuses you for asking questions, work for someone else. So not only am I going to talk about old stuff, and not only am I old, I've brought a quote that happened yesterday in 1910 from Teddy Roosevelt, who was not at that time, but was twice President of the United States. And the point of this quote is because I get to tell you what you should act like, because, you know, for today, I'm your parent. So, and so the point of this quote is that it's long and that it's gender wrong, and that he was talking to a group of men in France ahead of World War II, and he was talking about what happens as you become a nation. But what he's really talking about is not talking about something but doing it. And for all of you, you're sitting here at this wonderful academic institution, and you might be raising your eyes at that, but it is a wonderful academic institution, and you're wondering, what am I going to do? You're in Canberra, so it's going to require a little more effort. Now, whether you want to work in Shanghai, Sydney, Wellington, New York, London, or even Canberra, it's going to require a little bit of effort. And what I want to leave you with today is that you're going to have to make that effort. And you're going to have to show some enthusiasm. And if it's financial services that you're going into, you're going to have to know a little bit about financial services. You're all doing an applicable degree. You're all smart enough. So, you know, and so I don't want... Let me see if I've got a pointer. No. No. The last line is the one that... none of you should end up being a cold and timid soul. You all are going to have to make an effort, and you're all going to have to be... You're going to have to go slightly outside your comfort zone, because your comfort zone is an academic institution in Canberra. So that's just life. So let's briefly about me. So I did go to ANU. I have one degree, which compared to most people in this place is pretty poor, but it was a long time ago. And the reason I put my honours thesis a title up there is not because it was a particularly great thesis, not because it got published, not because they got, oh my God, you should be an academic, but it's because it's the industry that I actually went into. And some of you think, oh my God, I'm studying, it has no relevance to the real world. Well, it's not true. It has relevance to the real world. And I'll come back to what that relevance might or might not be, but I happened to study something that I liked, the industry opened up, I got a job, and here I am, 33 years later, still working in the same industry, still working in the same general industry, still looking at currencies, still strange enough to think currencies rule the world. But it happened for me, and I'm nothing out of the ordinary. It just, what you're studying can be something that you do. So I moved to Sydney at a place called Bankers Trust that doesn't exist anymore. I had to make effort. So there are such things in life. There used to be such things in life called public telephones. Superman used to get changed in one of them. But none of you probably even know what they are. But I had to do interviews outside the old refectory, I don't know what the new refectory looks like, on public telephones, because there was no one came to Canberra. No one said, oh my God, you go to ANU, we all want to employ you. So it's easier for you than it was for me, but the world's different. I'm not going to do the Monty Python shoebox skit, which none of you probably know. But I moved to Sydney, and then in '94, I went to Hong Kong because Goldman Sachs was my client, and they interviewed me, and I got a job. And then 24 years later, having worked in Hong Kong, Tokyo, and Sydney, I finally left. And I left because I wanted to learn more, even at my age. I wanted to do something different. And I now work for a firm called Point72. Point72 is a hedge fund. Goldman Sachs Bankers Trust was a bank/investment bank. Goldman Sachs is an investment bank. We can talk about what that means if you want. And Point72 is a hedge fund. What is a hedge fund? A hedge fund is a space shuttle of risk. It is a risk vehicle. It is there to make money, trade markets, use leverage. Excuse me. And so an investment bank it's really a series of hundreds of little businesses all into one conglomerate. And so that's me, but that's enough about me. So these are the 5 basic global financial markets. I told you this was pretty simple. But the point is that within each of those, and credit and equities are sort of micro because they're company focused, the rest are macro because they're top-down macroeconomic focused. Within each of those areas in the markets, there are literally, maybe not hundreds, but there's hundreds and hundreds and hundreds of opportunities and different job sets. And so each financial institution will say, I've got a person trading currencies and this currency and currency derivatives, and they're doing futures, and which is a derivative, I guess, and then someone else is doing fixed income, of which there are so many different subsets I can't name them all. My point to you is that international financial markets provide massive opportunities, and they provide massive opportunities on a number of sides. So we have the buy side. What's the buy side? The buy side is me. I buy things off banks. I buy shares, or I don't buy shares, but I could buy shares. I buy currencies. It doesn't mean that I go long or short. I transact with a broker. I trade futures. I trade commodities. But I'm a leveraged buy side. What is leverage? I invest. I don't have the amount of capital. I borrow from the firm more money than they give me, and so I get outsized returns and outside losses if I'm wrong. Unleveraged funds. Where's your superannuation? Do you have superannuation? It sits in the greatest amount of money in the world sits in long 60%-ish equities and long 40%-ish fixed income. It's what the Aussie supers of the world are doing every day. And that money continues to grow. In Australia, by legislation and by everywhere, the size of these funds just get bigger. It gets bigger and bigger. And then eventually individuals, if you buy a stock, you're a buy side. You say, oh, I bought this equity. Well, all of a sudden, you're a client of the broker. Sell side, banks and investment banks. The only difference between the two is that investment banks tend not to lend money and tend not to do traditional banking. Now, that's not true. They do a little bit of it, but it's not their dominant business. Banks, it's the opposite. It is their dominant business, but they do lots of investment banking stuff as well. I've been asked once today, so I'll answer it now. Is banking a bad career? Oh my gosh, is it terrible? The Hayne Royal Commission told me how bad banks were. How could I work for a bank? The opportunity set and the investment banking and banking side is still massive. And as a place to start your career, it provides you with a smorgasbord of opportunity. So many different areas to learn. You will not get paid more at a hedge fund to start than you will at a bank. From you, it's the same amount of money, give or take. But the opportunity set is massive, and your job is to learn and work out what part of financial markets you want to work in. And so it's an opportunity. Banks will hire literally hundreds more people than hedge funds will this year. Doesn't mean a hedge fund's a bad thing. They will hire hundreds more people than funds will this year. I'm just saying, for those of you who've decided that the press is right and banking is a bad career, I would probably rethink that. Now, if you may or may not want to be there 24 years like I was, but for the next 5 years, it provides a great opportunity. And then policymakers. I don't know how many of you have applied to the Reserve Bank or the Treasury for a scholarship, but policymakers are one that people don't really talk about. But it's what every other person up there is trying to guess and forecast. Are they going to cut rates? Are they going to spend fiscal? Is the economy going to grow? Is there going to be fiscal spending? Is the deficit? Like, people are asking those questions all the time. So it's a career that, and you're sitting here with oh my gosh, how can I work for the public service? But the Treasury is a great place to work. I looked it up because I didn't know this fact until last night or the night before, that only 29 of the 196 countries in the world don't have a stock exchange. Oh my gosh, there's no jobs. Think of the opportunity set. Every country has different rules, different regulations, and so it just provides so much opportunity for you. Futures and commodity exchanges are probably the same thing. I tried to work out, I was sitting this morning doing some reading, because this is the sort of exciting guy that I am, and I found out that the very first futures exchange was in Mesopotamia in 750 BC. I know, I told you it was going to get old. I didn't think I was going to get that old. Where the king said you can buy... So a futures exchange just means you exchange a standard amount at a certain price in the future. They all started as agriculture. So farmers could could hedge their product and had less price risk. Now they're pretty much anything trades on a futures or a commodity exchange. The London Metals Exchange started in the 1700s. I think that's right. No, it didn't. It started in the 1800s. The first futures exchange in the modern world was in Japan, rice futures in the 1700s. Now, I know that's pretty boring, but all I'm saying is you sit here and you think about tomorrow, but when you think about financial markets, you think about investing, you think about the process, history matters a little bit. They are doing the same thing, by and large, on the London Metals Exchange that they used to do in coffee shops in London in the 1800s. The art of buying and selling something, how you buy and sell it changes, but why you buy and sell it doesn't necessarily change. The electronic changes, the actual transaction, how it's sold, how it's bought, how it's reported, but the actual decision to buy or not buy, that stuff hasn't changed that much. Just remember that the biggest daily market in the world is the foreign exchange market. It's an OTC market. It's over the counter. There is some foreign exchange that there's some reporting, but by and large, it's an OTC, relatively unregulated market. And then there's the fixed income market, the next biggest market in the world. So stock markets aren't the biggest markets in the world, but there's lots of different. There's lots of opportunity. I've both been lucky and in some ways feel I missed out because I got to work in Hong Kong for 8 years and Tokyo for 3 years. And I regret not going to New York, but I had to make a decision at the time about family and where we wanted to live. Chicago is a major financial centre because that's where the futures market is, because that's where they used to take the agriculture. What does Brexit mean? It means you'd make some jokes and there's some videos on from comedians and you're not really sure what Brexit really means. And I'm not really sure what Brexit really means, and Theresa May isn't really sure what Brexit really means. But London used to be the only real financial centre in Europe. Some form of Brexit means that's going to change. So what does that mean? It means there's more opportunity. Hong Kong and Singapore, amazing cities. I now work partially in Singapore. I'm there on average 1 week a month. Hong Kong and Singapore just rose. Singapore by the will of a great leader to build a country, and Hong Kong by the collective will of a bunch of refugees that got forced out of China and created this amazing capitalist society. They have been the financial centres for Asia, despite challenges, for years and years and years. Their challenge is still coming, and it's coming with a big elephant, and it's running down the road. And of course, that's Shanghai. But Shanghai's different because the Chinese government's much more regulatory focused, much more controlling. So exactly how the Shanghai markets and the Chinese markets end up is not yet known. But they're deregulating faster than we all believed they would in 1997. Most of you weren't born. But still maybe not as fast as some hope for. Tokyo was the dominant financial market briefly because the size of the economy matters. But it's not as dominant anymore, and it's unlikely to ever. Shanghai will surpass it as a place to live and work in terms of financial markets. But it'll still be big. You kind of need to speak. You don't need to speak Japanese, but it's become a very Japanese-dominated market. Sydney has a niche market. It's got a time zone. It's also got a massive funds management industry sitting here growing every day. And then Moscow and Rio, I just sort of put those ones up. Seoul would be upset. There'd be all these cities that would be upset I didn't put them up there. But Moscow, because it's the only dominant market for Russia, what determines whether Russia's a good market to trade? Sanctions. It's a big economy, sanctions are what matters. And then Rio, because it's the biggest economy in that part of the world and has... But the point is not, oh my gosh, can I name 5 financial centres in the world? The point I'm trying to make to you all is that your opportunity, if you're prepared to make the effort, is global. Oh, what a segue. I didn't even write it like that. Where do you want to work in a globally integrated market? Well, you just want to work. But I want you to expand your thought process and think, how do I get a job? I didn't realise that I would end up working in Hong Kong or end up working in Tokyo, but you're going to have to take a little more control than I did because perhaps I was lucky. So where do I want to work? Do I want to be a buy side or sell side? You want to be either. You don't know where you want to be, but you want to be one of those two if you want to work in financial markets. A global or a local firm, well, it doesn't really matter, does it? But the global firm provides you with a travel opportunity. How do you get a travel opportunity? By doing well at what you do. It's not going to the military. They don't post you to Brisbane, then to Malaysia, then to Frankfurt, then somewhere else. You have to take the opportunity. You have to be the one who is the doer of the deeds, as Teddy Roosevelt said. Small or large firm? I work what now I think is now a small firm at 1,400 people. I used to work what I thought was also a smallish firm at 40,000 people. But the difference is you should be thinking about both, but the big firms will hire more people because they're bigger. That's just the way it is. So that's an opportunity. Again, don't rule out banks. Product. The only thing I'll say about product is repeating what I said earlier to someone. When you go for an interview, if you put that I did X and I know about X, they will ask you about it. So make sure you do know something about it. But the product suite for you is literally, it's unlimited. It's not, but it's close enough to unlimited. So, but what do I like? Do I like markets? Do I like derivatives? Do I like math? Do I like selling? Do I like trading? How do I know if I'm a trader? How do I know if I'm a salesperson? How do I know if I'm a quant? Well, quant's actually, how do I know if I'm a coder? You're not a coder unless you do a lot of code. So that's an easy one. Am I a quant? Am I completely math-based? Maybe. Am I a trader or a salesperson? What's a trader? Why do you... Try not to... If they ask you in an interview... Why do you think you'd be a good salesperson? Try not to say, because I like people. People always say, because I like people. Okay. Does anyone ever say they don't like people? Maybe. But think about, say, both. Most people want to be salespeople because they're scared of what trading means. But don't close your minds. Portfolio on the buy side. You're not going to be a portfolio manager. You're too young. Sorry, age does matter and experience does matter a little bit. But you will be. But if you want to be a portfolio manager, you have to start as an analyst. What do analysts do? They crunch numbers and equities. It's not a quant job. They're trying to make a difference. Financial markets are lightning fast transfer of information. And so how do I differentiate myself? I am able to anticipate what I think is going to happen. Technology. How can I work in these industries? Technology's taking all the jobs. There'll be no one left. There'll be no people. Machines will do everything. Currently, we're at almost record lows, not forever, but record lows of unemployment. Technology's marching on. It's not like you're the only ones that know about technology. The banks know about technology. They're spending billions of dollars trying to develop technology. They know about it. They're not saying, well, let's hire 50 people here in case this technology doesn't work. They're already adjusting to the new technology. You have to be open to it. You have to be, you wake up every day and you look at your phone, you already use technology, but it's not going to preclude working in the industry. Some jobs it may, but most things it's already here. Front office or operations, what's the difference? What's operations? It's very simple. One deals with clients or the markets, one deals with the I don't want to say admin because that's a bad word and everyone gets bored with it, but compliance, legal, absolutely necessary. Growth areas of banking. All of those areas make sense. So this is not, I'm going to talk about other stuff, but I really want to emphasise that the opportunity set for every single one of you is huge. But in every university around the world, there's a group of people like you, and maybe there's someone like me telling them the same thing. It's competitive. People want to work in the financial services industry. They want to be, they think whether it's job satisfaction, monetary gain, your banks have been paying people well for hundreds of years. So hedge funds have been paying people well for 50 years. It's a good industry still. But you do need to be a little bit specific. You can't, when you're going for these interviews, you need to decide, do I want to be in a banking, do I want to be a markets person or a banking person or this person? You do need to sort of make that call a little bit. Because if you want to be all three, they'll be like, she or he doesn't know what they want to do. It opens the world. And it opens the world because of the next point that people don't talk about. See, your view on what happens in the Australian economy and my view of what happens in the Australian economy, both are valid. Just because I'm older and been around doesn't make, people say, he's more informed, he's a wise old guy. But this gives a common bond. You can talk to people. Like, you can talk to people about, what did you think of this? Or what do you think of China? What do you think of the economy? You don't have to get into, isn't the Communist Party a great thing? Or isn't capitalism a great thing? You talk about markets and GDP, and it sounds boring, and they don't make movies about it. They make all the TV shows about lawyers. But it's not. Everyone who's in the industry, once you start this conversation, and remember that when you go for an interview, have an interest in what the firm does. You don't need to be a purely economics major to work in a bank or accounting major to work in a bank or any of these things. It's that common bond of financial markets. And if you want to be in equities, say you watch the equity market. And if you've ever bought a stock and you go for an interview and you're interviewing on an equity department, make sure you remember why you bought it, where you sold it, what you bought it. It's very simple. It's not as difficult as you think. Okay, so let's get into a little bit more specific of what you do right now is you live, you work, you all study, and you all get told the theory. And so and then the theory says that if interest rates go down, for example, I'll be biased towards currencies, the currency will fall. All the theory works over the long term. It is the basis for everything. But as I said last year to people, there's a path. And that path is what financial markets are about. How you get to where you get and what goes on and how you survive and when the markets are going against you. And that path is the practice. The theory is right. If you put interest rates up enough, the economy will slow. You've just seen it in the US last year. They raised rates 5 times in a row, got to 250, and the housing market started to slow. Everyone's like, oh my gosh, Australian houses are so expensive. When they cut rates last time, they cut rates because the economy was slowing and the China boom had slowed and the metals boom was over. Guess what? Housing prices went up. That was the point of cutting rates. Now like, oh my God, houses are too expensive. Because now they're coming off a little bit. So the theory works, but the practice of how you live through each of that theory is what we'll talk about a little bit. So that's a book. and it was published in October of 1999. And that's 99 and 2000 are really interesting periods. We're going to talk about those a little bit. And I apologise that we're always talking about history, but hopefully you'll get the lessons that I'm trying to teach you. So, oh, there's a price tag on it. I can't read it. So when that book, I'm going to show you, for this one I'm going to show you the result. So when that book was published, it's where the arrow is on the left, or the left. So the Dow Jones was about 10,000. So he publishes his book, 35,000. And then within 2 years, the stock market has fallen by 30-ish percent. The book's completely ridiculed. What an idiot. No idea. How could he write such rubbish? Yet today, the stock market is 26,000. And so what this is about, 2008, you were all worried whether your father or mother was going to keep their job and whether the world was going to collapse. It doesn't really look like that much on that chart. But at the time, when you're living that path, it dominates your life if you're in this business. People were, Lehman Brothers went bankrupt in the middle of towards the end of all that, and people lost their livelihood. So these are hugely, like you talk about financial markets like they're abstract, but people live and breathe and make a living, and people lost their livelihoods. So that move, which looks so small, anyway, it looks like he was pretty right. Of course, having said that, that'll be the top in the Dow Jones. But so now this is my favourite tree charts, because this is something I'm sure you'll all recognise. So this is Amazon. Everyone here knows what Amazon is. My God. My generation's so lucky. We could have bought Amazon at the IPO price in 97 of $18. It has split a few times, so it looks much lower than that. Okay. By the end of 99, because of the splits, I had about, if I put $100 in, I think I had 20 shares or 30 shares, I can't remember. And so it's gone to 100. What do? Sell, right? But or do you not sell? And then it falls. So what do you do here when it goes from 100 to 40? It falls 60%. This assumes you're not leveraged, it assumes you haven't bought any more. The path matters. Then it goes up again, and you're like, oh my God, why did I sell? I'm buying it back. I hope you didn't. At this point in time, there were two schools of thought, that the internet was the future and that the internet was a joke. Who was right? Briefly, the joke. Share price of Amazon fell 94% from its peak. It didn't make any money. It barely made any money in the next 10 years. 94%. If you didn't sell, whoever said sell, well done. Hopefully you bought it back down here. If you didn't sell, imagine how you're feeling. This is the essence of investing and trading. It's about psychology. It was an overvalued company. It couldn't say it had a price-earnings ratio because it didn't have any earnings. There was a book written called Clicks Not Bricks, which is a great name, and it turned out to be sort of right. But for years it wasn't right. But of course, what happened? That's the blip. $100 invested at the IPO is $120,000 today, doing nothing. Why didn't I do that? My generation had all the opportunity. But it didn't move. Look, in 2008, it still didn't make any money. And so I'm just saying that the path of these things, Apple was the first $1 trillion company, followed by Amazon. Apple went broke in the early 90s, I think, and didn't technically go broke, but was about to go bankrupt. News Corp, Rupert Murdoch's company, came down to one bank. I've forgotten the name of the bank, And if they'd said, fold the loan, it would have gone bankrupt. He just sold the bunch of the company to Disney, and each of the kids gets $10 billion. The path is important. Financial markets are about the path. Theory versus practice in exchange rates. I talked about my thesis before. This book was published in the early 1980s, and I have it still in my... I haven't read it since probably I was at ANU. And so it's got all the theory in it. The same theory that you're getting taught today is in this book. External accounts, interest rates, real effective exchange rates, stuff like this, all of this stuff. It's all in this book. I mean, I probably should read it, to be fair, but... and it was great for me because it was really easy. It's a really well-organised book. It's probably not on any academic list anymore. One of the great theories of foreign exchange is that over time the price will move to equate products in different countries. I mean, I sort of wrote my thesis on it. The most famous of these is now called the Big Mac Index, which is by The Economist magazine. And they said, look, on average, things tend to go to the right place in 10 years. 10 years. 10 years, I mean, who can wait 10 years? Who can invest for 10 years? 10 years. I've borrowed this from Deutsche Bank, so I better give them a plug. These are all the different types of currency evaluation methods, and they create this really cool wheel. Remember, it's good, marketing's part of life. Isn't it a cool wheel? Nice colours, nice circles. The world's cheapest currency, this is live as of last night or the night before. Turkish lira, most expensive currency, Chinese renminbi. Okay, this is just their theory. What's happened in the last 12 months? Oh, the second worst emerging market currency has been the Turkish lira. And the Chinese currency strengthened. Well, it's weakened a little bit, but it's in the top 10. Okay, maybe that's the 12 months. Maybe we've got to look at a shorter time frame. Let's see what happened. Oh, the Turkish lira is still the second worst performing currency, and the Chinese is better. Theory versus practice. 10 years. So the theory makes sense, you've got to think about it, but what matters at what point in time in financial markets? So, the yellow line, these are all from Bloomberg, which I assume none of you can afford because it's very expensive, but it's a very wonderful system. And to be fair, I wouldn't pay for it myself. The yellow line is the trade-weighted US dollar. World's most important currency still. There's a question on the Chinese currency that I'll answer later. And the white line is the current account. So as you can see, as it goes down, the deficit gets bigger. I said, well, currencies are easy, really. Look at that. As the dollar, the current account went out and the dollar fell. What are you talking about? Except there's this period in the middle from 2000 to 2003 where the dollar went up and the current account went down. What happened then? It's 3 or 4 years. We live day to day in markets. We mark to market all the time. Oh, and then what happened to the current account? It collapsed. You know why it collapsed? Because they had a depression. And one way to get rid of your current account deficit, have a depression. It works every time. Doesn't work in other ways. And the dollar kept falling. So, okay, that works occasionally. Let's look at interest rates. The white line is US 2-year government bond yields. The yellow line is the same thing. Very easy. Look, you're an idiot. That's what you're saying to me. You're an idiot. It's easy. When interest rates went up, the dollar went up. And then when interest rates went down, the dollar went down. Except then interest rates went up and the dollar went down. And then interest rates went down more and the dollar went up. Now it's working. Interest rates have gone up and the dollar's work. The point is that things change all the time in practice. What matters today, and one of the skills is what's driving things. And it's very hard because I can run any correlation model I want. And you know, you can't really run today's correlation different to yesterday's correlation. It doesn't really make any sense. But is correlation changing? And if correlation is changing, how is it changing and why is it changing? So when you combine them, yeah, it starts to make more sense. As you can see, at that point, what happened actually is that back in the 90s, they had a strong dollar policy in the Asian crisis, so the dollar went up. And then the US went into recession, so they started cutting rates, so the dollar collapsed because the current account was widening and the interest rates were going down, so it worked. And then in here, you're like, well, hold on, what happened there? What happened there I'll come back to. Then you had the crisis. So one rule of crisis, correlations go to 1, everything goes down, and the US dollar tends to go up because people take their money home. And now it's sort of working a little bit, except that in the last 6 months, current account hasn't changed, but interest rates have come down, the dollar's gone up. So I know I'm repeating myself, but what I'm trying to tell you is that everything you're learning is worth learning, but when you put it into practice, it's different on a day-to-day basis. This is, okay, you have to think slightly differently. So this is the euro-US dollar rate. So when it goes up, like the Aussie dollar, the euro goes up, and it's also the 2-year rate differential this time between European rates and US rates. And as you can see, as the differential went up, so that was that point I was talking about before, Europe was getting stronger. Europe runs a current account surplus, so the things are combining, the euro goes up, it goes up, it goes up. It kind of works, right? There's periods where it doesn't work and you have to... hold on, what about today? The euro is about 15% overvalued and has been for a while. And so if you ask me why it's not working, I'll say I'm not really sure. I've tried to sell the euro, hasn't worked, so I've stopped selling it. Because after a while, I can only hit my head against the wall so many times. It takes a few times, but I've stopped selling it because it's not working. And one of the other rules of financial markets is if you don't understand why it's not working, you cut your positions. So I don't understand. This is what's supposed to happen. It's not happening because sometimes it's time or sometimes something's happening that you don't realise. Because these markets, people talk about, people talk about financial markets like more buyers than sellers. How? I can't buy unless you sell. Now, I can be a more aggressive buyer, so prices go up, or you can be a more aggressive seller, i.e. you're prepared to pay the spread or sell the spread either way. But there's only ever buyers and sellers. And the other great myth, it's a zero-sum game. It's not. The reason it's not a zero-sum game is the same as when you go to the horses. You say, if I bet on every horse, I'll get my money back. No, because they don't add up to 100% and there's transaction costs. So it's not a zero-sum game. So in a zero-sum game, I only have to be better than, sorry, I pick you. I only have to be better than you and I'll win. But I don't. I have to be much better because I'm getting charged to play. So this is, I guess, partially my life because this is ANU and the floating of the Australian dollar, the collapse, and so I've been following this thing broadly since the 80s, but quite closely since 1986, which may not make me the most exciting dinner party guest if you want to talk about currencies. Or it actually will make me the most exciting dinner party guest if you want to talk about currencies. But all of you actually think about the value of the currency all the time, but you don't realise it. If I asked any of you what you would do on holiday if the Australian dollar was back at 1, I think most of you would say go overseas. Because it's so cheap. Every time you go on a holiday, you make a currency call. It doesn't make a lot of difference if it's 71 or 72 cents. If you think about it, it's a 1% different plus transaction costs. But it makes a huge amount of difference if it's 70 cents or if it's $1. Because if it's $1, it's strong against most things. So I'm going to Hawaii at $1, I'm going shopping. Or that's it. Or you start buying stuff from Amazon.com and not Amazon.com.au. This is not a plug for Amazon necessarily. So you make valuations. You already think about things like that. And you do it when you wake up in the morning. If you go online, you say, "Oh, you've no doubt got thousands of people trying to flog your junk on social media all the time." But you're looking at the price. You're saying, "Oh, in Australian dollars, it's X." So you're already doing these things. We can go through every move if you want, but you'll probably be bored. If you read nothing else, read this book. If you find it boring, don't become a trader. It was written in 1923 about a gentleman called Jesse Livermore, who was a trader. How can a book written in 1923 be relevant to today's society? Yet it is. I reread it recently. It's about the psychology of trading, about buying and selling. It's about it's the difference. Financial markets are a combination of art and science. You're learning a lot about the science, but you don't learn a lot about the art. Why do 20 different economists there's a great joke, I'm trying to remember the joke now, but if you put 20 economists in a room, you have 20 different opinions. That's the art. They all went to university, they all studied the macro, they all said, well, if this happens, then this should happen. Sometimes you'll only get 10 different opinions, sometimes you only get 5. You'll never get 20 similar opinions because there's an art. And so when you're getting into trading, there's a lot about psychology, there's a lot about the art, it's interpreting, like what does this price action mean? Why is it different? You've already got machines doing this pattern, last time it did this, you can work all of that out, but it's all about interpreting what the machine says. And the machine doesn't get to interpret, so it just does something. It doesn't mean it's right. Machine learning, there's a group of investors, if you're really interested, you can learn about the turtles. And it's about a group of investors who traded with very strict rules. And they were originally called turtle traders. They're now called CTAs, Commodity Trading Advisors. Because they all traded on the futures exchange initially. And if you really want to know, they were called turtles because there were 2 people in Singapore and they were at a turtle farm, and the guy said, "I can teach someone how to trade." And he said, "No, just as much as I could teach that turtle." He said, "No, you can't." And it's the basis of the moving trading places, which probably none of you have ever seen, but it's kind of a cool movie if you want to watch something. Anyway, this book is about the psychology. Every young trader, every young investor gets asked to read this book. This is a Bible for stock investors, and as you can see, Warren Buffett, it's his Bible. It was written by Benjamin Graham, and it's about value investing. What's value investing? There's thousands of different ways to invest. Value investing is buying when things are cheap and holding them. Is it the only way to invest? No. But I was asked to put some books in. So this one's a bit thick. If you're not into equities, don't pick it up. The one sad thing about financial market books is that you have to read the whole book and you probably only get 1 or 2 messages from it. So unfortunately, none of them are interesting cover to cover, but that's life. So I decided to go older. And just to prove that history matters. So this was Modern Delusions is the basis of another book called Modern Delusions and the Behaviour of Crowds. This was first written in 1841. I have not read this book, but I have it. How can that be relevant to today? Seriously, what is this guy talking about? This talks about manias in South Pacific, in Holland, I don't know when. There was a tulip mania where everyone had to buy tulips. How stupid's that? I mean, seriously. It's like saying, who would buy Bitcoin? There was a mania in your life 2 years ago in Bitcoin. It went from, I think, the start of the year around 5,000 to 20,000, and went most of that in December. There were commentators going, oh my gosh, this thing's going to 100,000, it's going to 1 million. Each of you thought to yourself at some point, why didn't I buy Bitcoin? Now you'd be saying, why didn't I sell Bitcoin? I don't know whether Bitcoin and blockchain technology, what it means. There's a lesson in that too. Commentators comment to get noticed. So if you're talking to someone who's in the Bitcoin industry, they'll tell you Bitcoin's going to 20,000. If you're talking to someone who thinks it's rubbish, they'll tell you it's going to zero. The 20,000 guy, I think, is probably likely to be more right, but I don't know. It's sitting at 5,000 and people flocked into the industry. Goldman Sachs opened a desk. Oh my gosh, Bitcoin's the future. It took less than 6 months for that future not to be quite what people thought it was. 1841, same lessons. Does that mean it's a bad thing? If you bought Bitcoin, if you were lucky enough to buy it, if you put $500, which I know for each of you is a reasonable amount of money, and it went to 10,000, what should you do? Probably sell it. So all I'm saying is that history keeps repeating, and the way you trade things and how you look at things and the information changes, but the art of it needs history to think about. This is a great book. This guy, Peter Lynch, managed a fund called the Fidelity Magellan Fund, and he started with, I can't remember the number, so I won't say, but in 2003 he had the best 20-year record of any mutual fund in history. And the essence of his book, and this is a lesson for all of you if you don't want to read the book, is that every day something is happening in your lives that may or may not be investable. So he talks about, the one thing I can remember from this book is he talks about leg stockings, which I don't even know if they still exist. And it was double L or double G, I can't remember that either. But his wife started, and all her friends started buying these stockings. And so he started looking into it and went, wow, this is a good company, and he bought the company. And that company went up. I think he bought the equity. I don't know how much he bought. But the point is that something that you're doing today is investable. If something is new and is changing your life, see what it's worth. Should you have bought Snapchat shares? No. Because it had already been priced. Should you, but you're already making investment decisions, but you don't realise it. So occasionally stop to think about that and say, well, I bought this. And then when you go for that interview at the financial services firm or the hedge fund or the mutual fund, and you say, yeah, this was my process. This is what I thought about. All of a sudden, they're more interested. They're more interested because... I can't take this call, can I? No. They're more interested because you've shown an interest in what they do. Now we get on to the real stuff. I can't change your academic history. You can't legally change your academic history. But it does matter. So as I've emphasised to people I've spoken to today already, there are two parts to getting a job. One of them is getting an interview. So there are two parts to getting an interview. One is your academic history. It is what it is. But if you think you need to kick it on a little bit, sorry, you're going to have to work a little bit harder. It doesn't... You should apply, if you say to yourself, I'm not smart enough, they won't accept me, woe is me, just put your application in. Experience. So all of a sudden now we're talking what you've done. If you've done nothing, well, none of you have done nothing, but put everything in, and don't lie, but don't be shy about putting stuff in. I've got a grade 5 piano, I've achieved grade 5 in piano, put it in. We hired someone at Goldman Sachs once, and she got noticed because she started a pool cleaning business. Wow, that's a bit of an issue. She's still working there today. You don't know what's going to catch people's eyes. But remember, resumes are not read by machines, they're read by people, and I used to get books of hundreds and hundreds of them, and they'd already been filtered once. So how do I notice you? Excuse me. How do I notice? How do you stand out? Because that's what you need. You need to know. You need for me, or whoever me is, the reader of those things, to notice you. So put your interests in. You know, you're allowed to put your interests. Don't have to be. I like writing pi to the 75th number blindfolded. Actually, that's not a bad one. But I mean, you know, like put them in there. Don't hold back. Just remember, if you put something on a resume, you will get asked about it. So don't put stuff that isn't true. Your cover letter is really important. It has to show an interest in the industry, in the firm, and why you, in your own words, are perfect for that job. Each of you, in your own words, has to be perfect for that job. Give it to your friend. Give it to someone to read. If they're like, if they're honest with you, and they don't say, wow, that's great, write it again. If they don't say, wow, that's great, write it again. If they don't say, wow, that's great, write it again. Write it. You've got to get noticed. I'm trying to get you all a job. I can't give you all a job, but I'm trying to get you all a job. Do some research. Like, you just know a few little things. It wasn't an interview. I was in a meeting earlier with a few people, and one of them said, I looked you up, I saw you sold this house, was that you? All of a sudden, she showed an interest. Like, that's all it needs. People want you to talk about them. Everyone has egos. It's like, how did he even, like, well, I mean, God, how big an ego has this guy got? That's all he's talking about. But no, but this is the firms. And there's going to be controversy. Try to avoid asking, how come your firm got fined $5 billion for doing this? Try, you know, know that these things have happened, but don't necessarily... They want to hire people who are interested in the industry and the firm. And you don't have to say, be so specific. I want to be the person that comes in at 7 o'clock and turns on the computer on the left side of the desk. Like, be a bit broad about the roles, but you can't be too broad. Unfortunately, you have to make some choices. I should have written be honest 50 times. If you put it on the resume and they ask you about it and you don't know anything about it, you're dead. You're gone. Say, sorry, I was just trying to catch you out, see if you knew what I was, see if you'd try and test me. So don't do that. Okay. That's about an hour. I can go back and talk about lots of things, but I'd rather answer your questions. So, repeat what I said. There are no dumb questions. You can ask me the same question multiple times, maybe 5 times. Let's see if I get ruffled. And you can ask me anything, but you have to shout. And literally, you can ask me anything. So, fire away. I don't know how I'm going to pick who's asking questions. There we go, that's easy.
First of all, thank you very much for your speech, which was really inspirational to all of us.
Thank you.
I'm asking you a question on behalf of my own initiative based on you.
Yeah.
Yeah, I got a resident who is a second-year student. Actually, I'm a master's student here.
Yes.
Got some experience before, but she did not have any experience.
Yes.
I want you to share some encouragement to her and some people similar to her as well, because I kind of want to set up kind of message on behalf of this stage to them to kind of encourage them to never give up their dreams and make sure they can get a good starting point without even fearing about they getting rejected from their resumes or applications. So what sort of things are you going to say?
Okay, well, the first thing is, it's not true that no one has any experience. They just have different experiences. So, all of you went to high school. Many of you have travelled across from different parts of the world. That's an experience. You know, I'm going to gross generalisation here. If you've come from China and lived in Canberra by yourself and studied at ANU, that's an experience. That taught you something. And so everyone has an experience. It's just that you're all too humble. You're trying to get a job. This is what I learned. Do you know why I'd be a good person to work for your firm? Because I've learned how different cultures work from where I've lived and worked. You don't have to have experience. You don't have to be a summer intern at JP Morgan or Goldman Sachs or .72 to have experience. You have experience. Working in a coffee shop is experience. Now, maybe you haven't worked in a coffee shop, but it's still experience. So when they ask you questions that they always ask in interviews, like, tell me how you solved a problem, it can be because someone got the wrong damn coffee and they lost it. That's a problem. It doesn't have to be, everything doesn't have to solve the world. And so everyone has, but you've got to think about this and you've got to be prepared for this and you've got to do some research and you've got to say, what are the most asked questions in interviews? And how will I answer that? And you have to be a little bit spontaneous as well. But I think just because you haven't had financial market experience, you still have experience. And so that's what I would say. And again, the reason I put that quote up from Teddy Roosevelt, you've got to be the doer of deeds. You've got to be prepared to, I can't remember the quote a bit, but you can fail. It's going to hurt if you send out 20 applications and you get lots of rejections. Hopefully you don't get 20, but even if you do, you've got to do it again. And again, and you just got to keep doing it. There's a guy who's currently employed at Goldman Sachs who came 2 or 3 years, he applied for a summer job, he applied for another job, he kept getting rejected, he's working there today. People notice, oh, hold on, this person applied last year and got rejected. Like, people notice, they want you to want them, as there was a song once which none of you will have ever heard. But I mean, so I think that's the answer. The answer is the experience is not where you necessarily think it is. And everything is experience. I haven't travelled from China to Canberra to live and study. I don't know what that's like. And therefore you can go back. Or I picked China, but it could be anywhere. Or I grew up, just because here I am. I went to school and university in Canberra. That was, I don't remember my interview questions, but it doesn't, nothing stops you being a chance. Next. Yes. Oh, okay. All right. Sorry. The question, which I didn't repeat before, was that, what if someone doesn't have experience? So I think you've got the answer. All right. Yes.
So in another class, we saw charts of the last 100 years, and then the view is that the last 100 years humans enjoyed really positive return in growth.
Yes. Population growth.
So we tend to look at last 20 years, 30 years to say history repeats itself. Do you think that the next 100 years will be very different from the window that we see as the last 50 years of investment return?
Okay, the question is, the last 100 years have been great for growth. Do I think in the last 50 years have been great for growth? Do I expect the next X years to be the same? Well, they won't be the same, that's for sure. So one of the couple of things are happening that the academic community is probably struggling with, and we're all struggling with, and that is that, it's something that you are all probably more on top of than me, and that is that the world is running out of stuff. In particular, it's getting too much carbon. So we've got global warming. It's running out of coolness, so to speak. Now, if you're a denier, you say, oh, nothing's really different. But the point is that the global population growth can't continue at the same pace. I can't remember the stats. The world hit 1 billion people in 200 years ago, 2 billion 100 years ago, 3 billion 50 years ago, da-da-da-da-da. It's not quite that dramatic. So, and population growth naturally equals GDP growth, and in the end, GDP growth and stock market returns are correlated. So how do you now exist in a world where population growth cannot continue at the same rate? Your generation won't allow it to continue, but it can't continue anyway because it's running out of space. So the answer is A, if I knew that, I'd probably be... I don't know the answer. No one knows the answer, I guess, is the question. Some people don't even know there's global warming, but anyway. The answer has to be in technology. And the poster child is Japan. And the reason is Japan's population is shrinking faster. So you've got a mature economy, a large economy, and a shrinking population. Japan's economy will shrink by about 10 million people in the next 10 or 15 years. Shrink. They just stopped having children. And they don't have immigration, by and large. So how do they survive? How do they continue? And they haven't grown. Japan's economy hasn't seriously grown during this period of slower. And so everyone has called the end of Japan for years and years and years, and it's still the same, but they're slowly spending a long built-up pile of wealth. So the answer has to be in technology. Do I need to have a convenience store that is open in Japan 24 hours a day, staffed by a human? No. Japanese, can I run a convenience store? Sorry to be... In some countries, I can't have a non-human there because people will take stuff. In some countries, I can, but I can work out the technology. And so it has to be technology and then productivity. And that's the way that it continues. And so, are we more efficient today? Is this generation that I'm talking to more efficient than my generation? By so far, it's ridiculous. I can now be as efficient as you because I can have the same technology. But when I was at ANU, we had a computer, and my thesis, I love to make this joke, but none of you ever laugh, was that when I cut and paste my charts into my thesis, I actually cut them out and pasted them. I actually used scissors and glue. And so, no one would even think about that. When I was sitting, I counted the number of people when I was sitting in the coffee shop this morning in the business and economics building actually had paper on their desk. I think there was 3. And so technology is the answer, but I don't know what... And so, yes, everyone should think, wow, I want to be in that technology company and I want to be in that startup and, like how do driverless cars work? In America, they're a disaster because a huge amount of people drive trucks. But eventually they're not a disaster because in Japan they're running out of truck drivers. Because they don't have enough people to drive the trucks, literally. And so what do? So Japan has amazing car companies. They should be developing driverless trucks. Now, maybe they are, maybe they aren't. And so that's my view. But I'm willing to bet that if we go back in history, there will always be someone say, well, that's it, the investment returns can never come back. We can never get... And there will be long periods where stock markets will have negative returns and it'll be tougher. But the S&P 500 goes up on average 7% a year. Now, part of that is a small scam in that if you're a bad company, they chuck you out and put good companies in. But that's what you're talking about. When I started, I talked about Amazon. There was no Amazon in 1995, and now there's an Amazon as one of the biggest companies in the world. I don't think that drive changes. Yeah.
Goldman Sachs has this emphasis on impact investment. It's quite a vague term to create positive impact and sustainable return. Do you think this is some sort of investment direction?
The question is about Goldman Sachs and impact investing, which is sort of a broad term to Australia has a green fund. Is this a way to invest? Yeah, it is. But it's much more difficult. You say, oh, come on. No one should ever put money in a cigarette company. Okay. What if the cigarette company's share price goes up 5% a year because they've got a good business and people want to smoke and it's legal? But it's morally bankrupt, but it's legal. But it's morally... There's no answer. You've got to decide how you want to invest. And so if you just want to invest in green... ERG investing, I've forgotten exactly what the term is, you want to take out, and there's been studies done that shows if you only pick those companies, on average, they do better. And so that's why this industry is building. But it doesn't, should you not buy, I don't think Smith & Wesson, should you not buy a gun company? That's your choice. I'm not going to tell you what to buy and what not to buy. If it's legal to hold guns in America, can I buy the stock? That's your choice. If I put money in a fund that's investing in an index that includes the gun company and it's 0.03% of my index, is that wrong? That's your choice. But it is an area that it is another way to look at investment, but that's a decision for the investor. And so what banks and investment banks and funds do is they come up with, it's like saying, would McDonald's run all-day breakfast if no one bought it? No. They're still companies. And so there's demand for this type of investing. It doesn't mean it's an alternative investment process, and it's perfectly valid, but you have to decide if you want to do it. Yes? Yes.
So on top of finding a right trustee to maximize the profit within as well as the assets and everything, I wondered how, at the same time, you can simultaneously enhance values such as family culture, family laws, and family education.
Okay, the question is about family trusts and how you can, I think, work through the conflict of maximising returns versus other issues, cultural issues, stuff like that. I think it's not just true of family trusts. Family trusts just have a slightly different culture because they're talking... A family trust is about a wealth preservation vehicle. You're not in it... By the time you set the trust up, you have a certain amount of money. And so you want to preserve that amount of money. And in essence, you want it to grow at the rate of inflation plus X, X being what you decide. So the first question is, what's the X? So if you want to maximise returns, you're going to have to give up, you're going to say, forget that, I'm buying only gun companies because everyone's shooting everyone else. So it depends, you have to set some rules. The higher bar you set to your return profile, the less rules you're going to be able to follow. So you're going to say, okay, we're going to put all of our money in, so what's the big bet? I'm going to buy Argentina, or I'm going to buy Venezuela. And that's the only way you're going to make 100% return in 12 months. So something that's in depression that comes out of it. But if we all thought we'd make 100% return, we'd all put our money there. So the chances are that you won't. So the first thing to decide is what sort of risk profile you want. And so that's true of most firms as well. Like, what do they want to do? Who do they want to lend money to? How far down the risk curve do you want to go? The further you go down the risk curve, the more risk you take, the more return you should, in theory, get. And so, but that changes. And it's all changed in the last 12 months in front of your eyes. If you go back, say 2 or 3 years ago, Australian banks were lending at anyone, you want to buy a house? Sure. The housing market was going up. There was no risk. They then went, hold on, this is getting a bit out of control. So they started to cut back, but they cut back for 2 reasons. One, because they were told to by the regulators. And so by the time you got to the Hayne Royal Commission, they'd already done it. So the Hayne Royal Commission, I'm not saying it was a waste of money, but by the time it got there, the banks had already anticipated and already adjusted. So the impact on their investing was minimal. That's why the Hayne Royal Commission, what really happened in the end, the banks had already changed. So they'd already changed their risk profile. And the market, because the regulators had told them to, and this is true wherever you go and work, what risk profile is going to be me and 3 other people and we're only going to buy corn futures. It probably has more risk to joining Goldman Sachs. And so you need to think about this when you're thinking about where to work, and you need to think about this when you're thinking about the family trust, or you go to a mutual fund. As most of you have probably had a job at some point in time, and maybe you've earned enough money to get some superannuation. Where do you want your superannuation? You're young. You can afford to lose money, even though you don't think you can. But you want a portion of it in stable super funds, and if it's people's retirement money, you don't want them betting. You want them betting on relatively conservatively, and so that's another point. How much risk do I want to take? And then you say, okay, well, I've got a little bit of spare money. I'm going to bet it on the horses. Well, good luck. But I mean, but I'm going to put it into Bitcoin, or I'm going to trade this, or this 2-cent stock. I mean, but don't do that with all the money. And that's the same as of having the bulk of your investments in stocks and fixed income, and then having some in alternatives. And so the fact, how does the culture change? Well, that's the culture of firms. Firms do have cultures, and it's hard to, because they'll all tell you. Every firm will tell you that they have the best culture and they care the most about their people. And ANU will probably tell you that as well. But I mean, and it's sort of true. They sort of do think their culture is the best because it's the culture that the firms, and firms have personalities. So a German firm will on average be different to an American firm, will be different to an Australian. It's a global world, but there's still differences. And so, that's part of it's cultural, and then the rest is how much, and culture's something you have to work on. It doesn't just happen. ANU just didn't become a great organisation because, it's in Canberra and it's a great place. People have to work on culture, so I think that's the other point. Whatever culture you want, you have to work on. Yes? Yes.
But for the next 10 years or maybe 12 years and so on, what's your opinion about China, the macroeconomics development and the stock market and so on?
Okay, so the essence of the question is, sorry, I remembered I had some questions that people had sent in. The question is, China's been fantastic for the last 20 years. What's my view going forward? So let's take the lesson of the day. History. When I started in financial markets, I was given a book. Can't remember it. I can't remember the name of it. It's about China. It was by a guy called William Overholt. And I went to see him speak. So this is sometime in the mid-80s. And sadly, I didn't completely listen to him. But what I learned, and I've never forgotten, is that Chinese GDP doubled from the mid-80s to the early 90s. And by that, it doubled because people went from 1 meal a day to 2 meals a day. And then from 2 meals a day to 3 meals a day. That's happened in my lifetime. And so the first 20 years, once you decide that the colour of the cat doesn't matter, if you know what that quote is, so from Deng Xiaoping, the colour of the cat it doesn't matter what colour of the cat that catches the mouse. That's a famous quote. And that was when he said, we can be capitalists, we don't have to be fully communist. And so the first 20 years was sort of, it's not easy, but it was sort of easy. Because you literally went from 1 meal a day to 2 meals a day to 3 meals a day to employment, to jobs, to a stock market, to a currency market, to a fixed income market. And you were growing at 20% at some points. Nominal GDP growth was 20% because you had this probably 100 years or maybe slightly less of pent-up demand and everything else that is still coming out today. And it's still growing at 6%, give or take. And in 2022, China will probably grow at 3%. Because it's so big, it can't grow at 6% anymore. And once Xi Jinping gets his doubling of the economy between 2010 and 2020, and you get through the 100-year anniversary of the Communist Party, they'll downgrade the growth targets because they know that it's unsustainable. But that doesn't mean that it's bad. America can't grow at 6%. It's too big, can't happen. Or if it does, well, I guess it can, but I don't know how. But I mean, so that's the first thing about China. The second thing about China is that the reform process continues to go on, and it's difficult. The pace of reform is faster than we all thought it would be, but you'd still want it to be faster. But it's still happening. And so there's more markets opening up. But they don't want all of the opportunities to go to foreign firms. That's not an illogical thing. China gets bad press. China could do with slightly better PR. I don't know who does their PR, but it could do with slightly better. So these are changes. They have to continue to open the economy. The wild card is that for some reason, I don't think there's any chance of that happening, that they revert to some more aggressive form of communism. I don't think that happens. The problem for China, as I talked about earlier, is that population growth is peaking. The one-child policy was a disaster because the number of... All of you then here that are of Chinese origin are quite rare if you're female because you're of childbearing age, sorry you are, and there's less of you than there should be because the one-child policy had huge male bias and it was only one child. And they have to work out how to get through that. And they're starting that process now. So China's workforce is peaking pretty soon. And hence, you don't want 6% GDP growth because you won't have enough workers because you haven't really got enough space for a lot of immigrants. So it's really interesting. Am I bearish? What I think China has to revert to, no. What I think China has to go to is a normal business cycle. So they kind of hide the business cycle. But you have to normalise, and your external account has to go, which it's already happening because your domestic economy has to grow, etc., etc. I would think that the opportunity set, I'm sort of sick of the word the Asian century. It's 2 words, I guess, even 3. But it kind of is. You know, it's still there. It's still potential. It's still got growth. And even if you'll get a hiccup and the Chinese will have to work out how they're going to react to that, and it probably won't be well. They'll increase regulation. But I think net, I think the future is that Shanghai, which I put up before, will be the dominant market centre, or Chinese markets, but the dominant... most of GDP growth in the world in the last 20 years is China. It's already the dominant force. And the great conflict in the world is the fact that America has no policy for a strong China. There's no China policy. There's randomness, and there's a few tariffs here and there, etc., which... probably not a good thing at the end of the day, especially if you've done economics at ANU. You don't believe in tariffs, the inefficiency that tariffs create. But yeah, I promise you one thing: it'll be interesting. So anyway, next. Yes.
Months ago, I listened to a lecture on blockchain.
Blockchain, yeah. Yes.
What's your opinion on investment on these virtual currencies?
Okay, we finally got to crypto. The funny thing about crypto is that no one can everyone can tell me that blockchain's a technology, but they're already sort of using blockchain. But if I buy a cryptocurrency, I don't get blockchain, I just get something that uses blockchain. And so that was one of the great mistruths, I guess, in the crypto bull market. But I don't want to, I'm not 100% sure of what their use will be. So what I think of them now is that they're relatively unregulated opportunity set to trade. I know that's cynical and probably the wrong answer, but they move around. And so, they rallied 20% one day. Now, that was on a false rumour. And the market itself... So I used to write a daily client email thing, And I first started talking about Bitcoin at $280, but you know what? I didn't buy it. I know, I'm embarrassing myself. But because Mt. Gox collapsed, and I thought, well, this thing isn't secure, people steal. The Mt. Gox case, which was a Japanese crypto Bitcoin marketplace, is still in court. But I think, I don't know the answer. But I know that, I don't think the answer is zero, and I don't think that you can't, I never thought you could buy milk with Bitcoin if Bitcoin was 20,000. Even if I could only buy $1 worth of Bitcoin to buy the milk. I never thought that was, money works. I know none of you use it, you all use electronic transfer, but money works. So you can't replace something, you can't disrupt something that actually works really well. You can only disrupt things that don't work so well. Money works. And already, again, when I was in the cafe earlier, I was the only one that paid with cash. Now, I could have paid with my phone or my card or whatever, but I just paid with cash. And so it's already, the payment system's very efficient, and it already is. And yeah, blockchain's a great ledger. So I don't know the answer, but I know that I don't think they're going away, but I also don't think they're going to 20,000. So maybe, but I don't know. I'm sure people here will know more than me. Yes. Definitely. And that's the great hope, that the internet was never written off, but Amazon was. But I put Amazon up there. I could have put pets.com up there. That went bankrupt. So plenty of things went bankrupt, and sort of that's the period we're in. So the great crypto hope is that we're in this period now where you sort it all out, and a few firms, and I mean, ICOs were dodgy, right? A lot of them were complete scams. But I was shown an investment recently in a solar project that you got a cryptocurrency on, and they just said, oh, it's easier to raise money. So maybe that's the answer. And I said, why don't you use cash? I said, this is easier, it's tradable, it's transferable. And so I think they do have a medium of exchange role, but it's not to buy milk, because I don't need it to buy milk. And so maybe there I've answered. There you go. Now, next. Yes. Yes. Last financial crisis was in 2008. The next one is coming. What do I think? I think that we're all in danger of fighting yesterday's battle. I think that, so the last two US recessions have been balance sheet recessions. Both of them caused, well, sorry, not both of them. The first one caused by the 99 rally in the stock market, and the second one caused by a rally in housing prices. So the US had two balance sheet recessions, and prior to that, every recession in the US was caused by the Federal Reserve raising rates too much. And so you've had sort of macro recessions and now balance sheet recessions. The private sector balance sheet in the US is healthy. They're in a net surplus position. And so you can't, if you own, so this is sort of interesting because Japan hasn't had any GDP growth for a long time, but they've got this massive balance sheet. They're a net creditor nation, and they're slowly running that money down because they're not growing. But it takes a long time to get rid of that money. I think that crises never come from where you think about they come from. And if you look in the 1930s depression, then 1937, 38, the equity market came down, and then it went to, then you had a war, that didn't help. But I mean, after that, the 50s sort of cleaned the war sort of cleaned a lot of people out, I guess, and then you sort of grew for a long time, and the next sort of serious recession was in the 70s when the oil price went up. And so I think that people worry too much about the last recession, because it's 10 years past. The US economy, the stock market's got to 666 and wherever it is now in the S&P, and now it's, almost 3,000. And so, yeah, you got some financial excesses, but you don't have them to the same extent. And so, if you ask me where the risks are in the world, I think the risks are that as each of you vote in the future, you're like, well, I don't like the status quo, and so I'm voting for these alternative parties. And that's, of course, valid. And so it's got to be alternative policies. And so the UK is kind of interesting, because the UK is in this massive political upheaval due to Brexit, and if the Labour Party get in, they have some quite radical views. And so the reason there's no inflation in the world, I don't think, is that two things. One, you haven't closed all the output gaps, but more importantly, you get large structural inflation when you have structural impediments. The world is deregulated, and so the prices change a lot. One of the greatest things Australia did, and one of the reasons there's been no recession since 1991, is because the float of the Australian dollar has buffeted. And so, funnily enough, macro markets work. And so you need to get re-regulation and impediments in the market that create an inflationary boost. Otherwise, I'm not sure. Maybe interest rates, people say there's a debt bubble, but if interest rates are so low, then the debt bubble's not a big a deal. So so it has to come from a bursting of the debt bubble. How do you burst the debt bubble? You have to put rates up. How do you put rates up? You have to have inflation. How do you create inflation? And that's the billion-dollar question that maybe more than a billion, is that no one really knows. But regulation that imposes structural impediments in the economy can create inflation. So I think it's a while away. Downturn. Australia may or may not have a recession pretty soon because of the housing downturn, but the government's spending fiscally, and they'll probably cut rates at some point in time. But the world's sort of a two-pronged place now. America, China. That's what matters. Europe feeds off Chinese demand, and Japan is net export. Domestic growth in Japan doesn't really exist on a sustainable basis. So they're the two things that matter. So the US is probably okay for a while. You could have a downturn, but crisis. And so it comes back to China. And so is there too much debt in China? Probably. But they solve it by going for 3% GDP growth and stop the excess credit growth. And so you get more sustainable growth rate. But you're going to have a brief period of recession and a few close. But there's a difference between a recession and a cycle and 2008. So if history is worth anything, you probably won't see another 2008, ever. He says, scarily. Yes?
Just follow up that question. I want to ask something more specific. Talking about Singapore, because Singapore's economy...
Okay. Talking about Singapore, yeah.
Yes, scale economy, and I know you have been working there and you got experience there about Singapore.
Yes.
So now there's a trade war between two biggest economies.
Yes.
And America, both of them are strong partners for Singapore as well. So how could Singapore sustain their competitiveness? I mean, they have no natural resources, and for this very tough environment, how can they kind of manage their policy to maintain the economic growth rate? It's not so high, like 1% or 2%, but still, how can they kind of...
So the question is, how can Singapore sustain its economic growth? So the first thing is that the battle between the US and China will never go away, but it won't, I don't think, result in either side ever. It's unlikely that either side will ever force the other side into recession, because one goes into recession, they both go into recession. So they'll push it. We're going to live in an interesting world, because we haven't lived in the US has been the dominant global economy since World War II. Now, others have grown, and the US, if you want to sing the praises of the US, they were very generous over the past 50 years in their first support of the countries that lost the war, and then how they funded institutions, etc., etc. So the first thing is, I don't think the two of them butt heads they butt heads, but they always stop short of major conflict. And so why do I think that? Well, Russia, Japan, all were in sort of not the same, but similar situations. This is a big deal. China is a big deal for the US, and I don't know that they really know what to do. So, but the question is on Singapore. So you ask yourself, what is Singapore? Singapore is the greatest man-made economy in the history of the world. Lee Kuan Yew, there should be a statue on every corner. He created from a non-resource swamp this amazing, vibrant place. And he did it... Sorry, I'm just trying to think. A friend of mine had dinner with him, obviously before he died, and he quoted something and he said, it was such a simple answer. The friend of mine was the New Zealand Prime Minister at the time. But I mean, anyway, I'm dropping names. I think the thing with Singapore is, A, it's got lots of money. There's lots of wealth in Singapore, and it's had to artificially create these businesses: financial services, chemicals, oil, and now another round of financial services because it's sort of become a family office, safe haven place. What's it going to lose? It's unlikely to lose the pharmaceutical business for a long period of time because, you know, are you going to buy your drugs from Singapore or you buy your drugs from China? For a while, you're probably going to buy them from Singapore. Not those sort of drugs. But they're going to have competition on the oil side starting next year because China's building big oil refinancing and shipping because there's some stuff going on. So they're going to be competitive, but the issue is that, I don't know, I think their future is less positive, but still positive. Because China is going to take some business, but probably not all of the business. But it's a re-export centre. I 20 years from now, how long does it? I mean, Japan hasn't grown since the early 90s and still got money. So if you've built up years, I mean, they run a 16% current account surplus of GDP or something ridiculous. So the money coming in is massive every year. So they're a very wealthy place. It takes hard, as long as they don't try and buy Malaysia, you know, it's hard to blow all that in a period of time. And so it comes down to the ingenuity of the leadership because it's a leadership-based place. You know, the government, I mean, it's a benevolent dictatorship. You know, only one family gets to run it. So we'll see what happens eventually. But I mean, but it won't happen in BG Lee's lifetime probably. So I think it's probably okay. You know, if you got offered a job there, should you take it? Yes. It's safe. It's nice. It's warm. It's low tax. They can always put taxes up, I guess. But places like that, it has such ingenuity that I would think they'll reinvent themselves. They'll find some other thing to do. You know, it's the nature of it's like the culture of the country. Okay, any other? Yes. Okay. Is it under or overvalued? Currency valuations are difficult, as I pointed out before. So I think, first question, bigger picture, yes. The Chinese recognise that the US has a massive comparative advantage because all commodities are priced in dollars. And so think about what that means. So let's say you've got Japan that has no energy, that has to import all its energy. So there's always FX risk because oil is priced in dollars and the Japanese companies earn yen. And then, or iron ore or LNG is priced in dollars or Aussie dollars or whatever it is. So, but if I'm in the US and I need to buy oil, it's priced in dollars, I earn dollars. So that makes my life easier. So what the Chinese are trying to do longer term is they're trying to get commodities priced in yuan. Now, they've got the Dalian Futures Exchange, and they do price stuff, so they're working on it. I think that's really clever. Over time, they're going to... The US is very close to being energy self-sufficient, and so China is going to be the main importer of energy. Or Asia is going to be the main importer of energy, I guess. I'm guessing that a little bit. Anyway, and so if you can price it in your local currency, it reduces the transaction costs and the risk for your local country, and it makes life easier. So that's the first thing. So yeah, and as you do that, your status goes up. Now, if you look, so the first part of status is, are people prepared to hold your currency as a reserve currency? The dollar is still 60-ish, 50-ish% of global reserves. So countries holding their foreign exchange reserves, because the dollar is always a dollar. Like it has a history of stability that cannot be even Trump can't undermine that. It doesn't mean the price doesn't go up or down, but if you're going to keep, what do you keep under your, if you're a criminal, what do you keep under the mattress? You always keep some US dollars. If you're going somewhere, you always have US dollars. US dollars are, like, they've still got that status. China doesn't have that status yet. I'm not saying criminals don't keep yuan. Interestingly, one of the great moves of currencies in the last 20 years was the move out of euro into Swiss, because they changed the rules and made it more reportable, so all the criminals had to move their euro into Swiss francs. And so these things matter. But, I mean, so the first thing is yes, it's going to be amazing. China's not going away, and the currency's not going away, and the bond market's opening up, and will they change the rules? Really, really, really slowly. And this eventually will be a problem, because two things are going on. Number one, you live in Beijing, you've made a little bit of money. You think, okay, I've got a bit of spare renminbi here. I might put 10% in US equities. That's not a capital flight, that's a logical diversification of your risk. And so there's a portion of, and so they've shut down. So now it's 50,000 per person per year or something. And so they've shut down that level of capital outflow. And that means that if you open the door, there's going to be a flood of money rolling out. And they're not going to, and the Chinese have a better ability to enforce those laws, because they will knock on the door with a guy with a gun, and you're like, ooh, okay, that changes my opinion. And so I think that's going to be a problem for them, and so they can only move really incrementally. And the reason it's a problem is because what I talked about before, the exchange rate is one of your macroeconomic policy tools. You've got interest rates go down, the exchange rate goes down. This is all happening at a time when the Chinese external account is shrinking. It's shrinking for a very simple reason. It's not really shrinking because of Trump. It's shrinking because China just imports more over time. Because the domestic economy, the size of you're growing at 6% a year, it's not all exports. After a while, it becomes domestic as well. And so, but if that so you're able to fund the current account deficit for a few years via bond inflows, but then how do you fund it? How do you fund an external deficit? You let the currency fall. But if you don't let the currency fall, then how do you get money in? You have to put interest rates up, but then you're crunching the economy. So they're taking away a policy lever, which is a mistake in the end. And so at some point they have to get mature enough to say, okay, we're prepared to let the currency float. But that's really difficult, because everyone there wants to put 10% of their money outside, because that's diversification of risk. And so it's a great dilemma. I don't really have the answer. Is it under or overvalued? Now that the external account's gone down, it's probably fairly valued. But you've also, the other problem for the Chinese is that they've written a line in the sand at 7 to the dollar. It can't trade above 7. Oh my God, it can't trade above 7. But eventually, if the economy crunches, it will trade above 7. I mean, it's a variable. Otherwise, you create a fixed exchange rate, and you go back. What happens when fixed exchange rates devalue is you create depressions, because people start borrowing overseas. Because to defend your exchange rate, see, what they've done is close the capital account. But eventually, you have to keep raising interest rates to keep the currency from falling. because the pent-up demand to get out. And so eventually, and then you create, and then people borrow overseas, so they create international liabilities, and then you devalue and it creates a depression. Ergo, Thailand in 1997. So, and it can happen to anyone. So they've got a few issues. But at the moment, it's fairly valued and it won't move much. You know, if anything, it might strengthen a little bit. So.
What's your view on the piling up of dry powders in the private market?
The piling up of what? Dry
Powders, there's excess wealth within the private equity industry. When banks are regulated to lend less, there are offshore shadow banking for these funds that lend to people.
I thought you were talking about milk powder or dairy powder, but anyway.
The dry powders in the industry. So do you think it's going to pose crisis or opportunities?
I'm not an expert on that, so I don't know. I mean, they're talking about cash build up in the private equity business. I think that shadow banking, non-bank financial lenders, etc., tend to be less regulated, so they tend to be the poster child for things that blow up over time. But it takes a long time to get there. So let's think about Australia. So the banks have reduced their lending, and so if you go out and say, I want a home loan, you'll get all of these hits. And yeah, a few of them will be banks, and then there'll be these other ones that you don't know of, and they may or may not be more expensive because their funding is more expensive. They don't have the deposit base. But that process is less than 12 months old in Australia. So it takes, to build up significant financial imbalances, takes time. You can't do it in a week. You can't do it in a year. You've got to do it over a multi-year period. And so, yeah, I mean, maybe, but then that blows up and the banks, if you look at 2008, the banks bought Aussie home loans and everyone else and then controlled the market. So you've got them to come back. So I don't know about crisis. I think you should all ban the word bubble and crisis from your at your age, you should all assume that you want bubbles because you want things to go up a lot so you can buy and then remember to sell them. But yeah, I don't know about crisis. I don't know. Sorry. Next. Any more? Any questions? Yes, good. Finally, one from the back. Yeah. I have no idea what I put in my resume. It would have been pathetically small, whatever it was. I don't even remember. I've written one since, but I don't even remember writing one in those days. I'm sure I did, but I can't remember it. It's more, and then the job at Goldman Sachs, I had to hand in my resume, but they'd interviewed me, they'd approached me. One of the great ways to get jobs that you can't control is word of mouth. People love to ask, do you know anyone good? I'd say all of you, but I can't remember all your names. And so the Goldman Sachs job came from word of mouth, and there was stuff that was going on that I didn't know about, and they'd called a few very big and prominent clients who happened to like me, and they'd said very good things. So Goldman Sachs is not rumoured, is reputation to do a lot of interviews, and I did 2. So it doesn't mean that I'm much better than everyone else. It's just that there was a different time. So the question is, so I don't remember what I put in. So it's a question of what you should put in. The first thing you should do is you should go home. I'm not an expert on resume writing, but I think at the end of this I'm going to start an interview course, and you can all pay me to practice interviews. And as I said to some people earlier, people spend years at university, study hard, send off and then go, oh my God, I need to get a job. And they sort of, I don't know, maybe Ding Ding can prove me wrong, but I mean, like, they don't spend enough time thinking. Like, you spend a lot of time thinking about it, but you don't spend enough time really working on it. You don't have to be this bad, but I once had a client, and I was at a conference in Phuket, and we're driving from dinner or something, and it was in a taxi or a car, and I was talking to this client, and he had a rather large opinion of himself. Anyway, he opened his briefcase and he had his track record. As an investor, you keep your track record. He carried it with him at all times. And it seems silly, but in hindsight, you sort of need to carry your resume in your head with you at all times. If you want, you can carry your resume with you at all times on your phone. But I mean, having done these speeches for 4 or 5 years now, and my view is that, and spent years in doing lots of recruiting at Goldman Sachs, my view is that you don't put enough effort and time and work into them. And in America, they're all cookie cutter. They're all the same. You're like, oh my gosh, I've got to read 70 of these. And then one thing that I don't think you do is you don't spend enough time checking with each other, and you don't spend enough time practice interviewing. So the resume, as I said earlier, get stuff into it that makes you look slightly different. Your academic transcript comes as bang, and then, but you've got to have somewhere down there, what do you like? What do you do? Something, the person may or may not read that bit, but they might, like, if they can say, tell me why you like listening to classical music, or tell me why, I don't know, make something up. But I mean, why you love tennis, or why you do this, or why you do that. And then it gives you a chance to talk about it. That's why you put it on. It might get noticed, and B, if someone asks you about it, it's something you know about, it's something you like. It's easier to talk about things you like. Then as I said earlier about the cover letter, write why you are the only person in the world that this firm should hire. Only one. Sorry, you're competing with the person next to you. But only person in the world. And then if it's not strong enough, write it again and get someone to have a look at it. And then practice interviews. Get one of your friends and tell them not to be weak and soft, and tell them to interview you and ask you questions, and not tell them to be relatively serious about it, but and do it, and then do it again, and then do it with a bottle of wine if you want, or do something, but practice the interview process. Be prepared, because you're going to be nervous. So think about a sports person or woman. What they're trying to do is muscle recognition, so that when the stress comes into their head, and what we're trying to do in financial investing is mental recognition. So when the stress gets in, we revert to what we're trained to do. And we don't do it well mentally. And so you don't do it at all in interviews, but that's going to be the most stressful thing once you get in that interview room. And you sit there and there's all these other people and you doubt yourself and you say, oh my gosh, I've only got a master's degree from ANU, I'm not smart enough. Well, every time you think that, slap yourself in the face. But I mean, but practice. Be prepared to sit down. I don't know, I'm making this up as I go, but I mean, you've got to have muscle recognition and mental muscle recognition. When they ask these questions, you go bang, 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 bang. And then because I guarantee you someone's going to ask you a question that you're not prepared for. And you're going to have to, and then it's the process. It's not getting it right. It's the thought process of how, so practice thinking out loud. Say, okay, like this, the stupid ones, like why a manhole covers, why are they called manholes? But why a manhole covers round. If you don't know the answer, it's because it can't fall down a round hole. A square hole can fall. If you go online, that's one of the things you'll find. So now you know if you get asked that question. But, If you're in a maths, they might ask you a math question. If you're going for if a coder or a quant, they're going to ask you maths questions. So be prepared, but you'll be prepared. But if you're not going for those jobs, just practice. Practice with each other. I don't know of anyone who's ever done, practice interviews, and yet that's going to determine whether you get it. That's going to be a major determinant on whether you get a job. And sorry, I can't remember what was in my resume. Yes. Oh, yes. You've had a few. What kind of jobs would be done by robots? I guess I don't know the answer. The question is, given the change in technology, what will be done by robots? I guess you could... I think lots of things will be done by robots, but it'll be a slow process. So again, go back to my car example. The US can't replace all truck drivers with self-driving cars because there's too many people employed in the industry, and it's still a democracy, and people get to vote. Robots don't get to vote. So, but Japan can. So it'll be different in different places. Obviously, stuff that requires just simple recognition will probably go down that road. But I think that it's unlikely. It's great if you can be a disruptor, but if you can't be a disruptor, I think when you're going for a job, just think, okay, how important is the human element? Like, how important is the art versus the science? You're doing economics. Is it art or science? It's science followed by art. Start with the science. If it's only science, then probably a robot can do it. If it's art, then a robot can only do it to a point. So think about human resources. Robots can't do human resources. Well, it would be a very inhuman firm if they did. There's lots of things that they can't do. Do I need, when I fly back to Sydney in a few hours, can a robot replace the steward or stewardess or whatever they're called now? No, because if there's an emergency, the robot can't work. So I don't know the answer, but I would just think how much, if it's 100% science, then a robot can do it. If it's 80% science, probably, and if it's 50-50, I don't think it can be replaced. But I don't know the answer. Yeah.
Talking about the upcoming federal election.
Yes. Yes.
And Bill Shorten somehow implied that this coalition party is kind of too optimistic for the future.
Yes.
I kind of want to ask you about your commentary regarding this budget.
Okay. Firstly, I won't make any comment on the rights and wrongs of either political side. You all get to vote whichever way you want to vote. My opinion is not relevant. I think that as a general rule, governments always project into the future. So there used to be a rule where you got into power and the first thing you did was throw your hands in the air and say, things are much worse than I thought they were. And we've got to cut all these services. And so then you cut all these services, and this created a 4-year cycle in the US stock market. So the new president comes in, goes, I know I'm talking about America, goes, things are much worse, we've got to cut all this spending, and then uses that money, and then 2 years out from the presidential election starts spending. Now Trump's thrown that, Trump and actually George W. Bush sort of changed that, and they didn't. Obama was forced to because he inherited the Depression. But they sort of spent early, so it's a bit weird. But that's the basic political cycle, or that's how it used to work. And so governments will always project a better outcome. But you do have an independent, I think it's the CBO, or maybe that's in the US, an independent budget office that's supposed to verify the numbers. You know, I've met people there, I believe they're independent. So I think they're probably, you've got to be within, will they be right? No. But are they within realms of realistic? Yes. Because they are, you can't, if the numbers, he'll say their numbers are wrong, but if he thought the numbers were actually wrong and he could prove it, he'd put it on paper, and he can't, because it's a forecast. And so, but if you forecast that the Australian economy will grow at, like I think they forecast 3% growth, that's a little optimistic in the short term, but it might be fine next year, you know, to average that. So they're always a little too optimistic, but it's the same in New Zealand, it's the same everywhere. That's just the nature of government, that you project that you're doing better, you know, and things are better under you. If they were, but think of if they projected 6% GDP growth, that would be so unbelievable. I don't know that when Australia last grew at 6%, that would be political suicide. So they're within the realms of reasonable. I don't know how reasonable, but they're not. Yeah. And yes. Sorry, I can't hear you. How do I predict it? So I was asked at an earlier meeting whether I thought financial markets were efficient. And I think they're efficient in different time frames. They're very efficient long term, and they're very efficient immediately. And that means that all of today's price, given the amount of information that is freely available, is pretty much in the price. And so that means that the price has carries with it an enormous amount of information value. And so how the prices are reacting is giving me information. And so that's the key thing. The key thing is, longer term, what do I think? Okay, but short term, what's the price action telling me? And this is true across all financial markets. So think about, as a sort of rule, if prices don't react, like if a lot of bad news comes out about something and the price doesn't go down, that's a sign. That's okay. Was it music or someone ringing you? And so at big turning points, you get consensus. Well, so there was a big turning point a few years ago in iron ore when it was $30, $35. Everyone said it's going to 15, Fortescue's going bankrupt, blah, blah, blah. But it stopped going down. And so the price is giving you information. So you shouldn't think that the price is wrong. You can think that the price today won't be the price tomorrow, but the price right now is giving you a lot of information. And so that's the key issue, and that's even more important in markets, well, in all markets. So let's say a stock has really bad earnings, it doesn't go down. Like, okay, well, that's an interesting dilemma. What do you do about that? Maybe you cut the position if you're short. You say, because all of the bad news is in the market. And so turning points are really driven by, like extreme turning points. I talked about the Australian dollar being 1, but it actually went to 111. Like it was overvalued for a long time. And things stay out of whack. So you're really looking, what you're looking is like the market to run out of steam. And timing's important. If you can be bearish on an equity. If you'd been Amazon's a bad example, but you can be bearish on an equity and it can double in value and you can't hold it for that long. So it's how the price is reacting is the main thing. And so what I do every day is I'm constantly looking at charts, because charts have got all of that price information. How has the price reacted? Was there news? What are the different time frames of charts saying? Is it in a medium-term downtrend? Are we bouncing? And then after that, it's the art of trying to, predict / guess what will happen. All right, I can't see if you're happy or not, so I can't see that far. I can see. Anything else? Are we done? Oh, yep. I can't hear you, sorry. Yeah. Okay, so I think the question was, correct me if I'm wrong, Sri Lanka, terrible things over the weekend, horrific. Japan, possible earthquake, how I think the currency market would react. Okay. Yeah, well, the financial markets, you could argue, don't have a moral compass, but what they don't do, so one of the interesting things about 9/11 was that the equity, they found that someone had shorted the equity market beforehand, and I think they found out it was the terror organisation, but I can't remember. And so what financial markets don't do now, which may be the only moral compass they have, is that they tend not to react in the short term. So if you have but then it depends on the extent. So 9/11 was such a shock that it impacted the economy, and drove the economy into a short-term recession. This is such a big impact, I think, on Sri Lanka, though, as a percentage of the population, or New Zealand in Christchurch. The markets don't really do anything on that. And so, but earthquakes, the interesting one, so the earthquakes were slightly more interesting. So Japan has had a couple of massive earthquakes. The first one was the Kyoto earthquake, I think in the 90s. Sometime in the 90s, I can't remember exactly when. And so this is where currencies get a bit weird. So what happens when Japan has a natural disaster is the currency strengthens. You're like, what? That doesn't make any sense. And what happened in 9/11 is that the Fed cut rates and the dollar fell. How can that makes no sense? One was a massive hit on confidence, but the other one was a natural disaster. And in New Zealand's case, the Christchurch earthquake, not the horrific shooting, but the Christchurch earthquake was one of the greatest natural disasters as a percentage of GDP in history, and I can't remember the numbers. But the Kiwi dollar went up. And so what happened in all cases? In the US case, the Fed cut rates and people lost confidence and the economy went into recession, so the dollar fell. In the Japan cases, Japan has a massive net external surplus. They're a net creditor to the world. They're still massive offshore investors. So when something goes wrong, they bring money home. And it's one of the reasons that when the equity market falls, in the global equity markets fall, the yen strengthens, because the Japanese bring money home. They buy yen. And so it's one of the quirky things where Japan's had this long-term low growth rate, but the currency's always been strong because they've got this massive, or they've had, not so massive now, but a massive external surplus, and you've got a natural inclination to buy yen. Why did the Kiwi go up? Because of reinsurance flows, because Christchurch was not insured domestically, it was insured by foreigners who had to then pay New Zealand dollars in. So it's a bit quirky. So in every case, it sort of depends on the flow, but when New Zealand, when the earthquake hit in Christchurch, people sold the Kiwi dollar because they thought, oh, that's bad. And then subsequently, they couldn't work out why it kept going up. But you don't know that all the insurance flows are offshore. So it's kind of trying to work out where that flow of money is going to go in each case. And it's not a simple answer. I hope that answered your questions. Okay. Any more? All right. Oh. Investment recommendations? No. What are the exciting things I'm doing? I guess, the most exciting thing I'm doing is talking to you lot. But aside from that, No, the most exciting thing is changing from the buy side, sell side to the buy side, trying to invest. Markets, currency markets, I'm basically a currency and commodity and fixed income guy, are quite low volatility, so that makes it harder. Low volatility in equity markets is a positive. Low volatility in macro markets is much tougher for traders. That's the really exciting thing. The really exciting thing is that after 24 years and 33 years on the sell side, I was lucky enough to be offered a job on the other side and sort of so everything I believe I now have to put into practice. And so it's easy to think, well, that's how you hit a golf ball, but when you stand over a golf ball and try to hit it, it doesn't always go where you want to go. And so I'm having to not so much relearn, but both relearn and practice and try new things. I mean, the markets, financial markets they're hugely, there's unlimited amount of people. And if you think, some small number of people watch Game of Thrones compared to who watches the Federal Reserve. And so, I mean, literally, when the Fed is making an announcement, millions and millions of people around the world are sitting in front of their screen at home. Maybe it's 4 a.m. in the morning here in Sydney, or 2 a.m. in New Zealand, or wherever you are, and they're all watching the Fed. Like, it's huge, and so there's no free lunch. Another great economist saying, and so it requires a lot of work, and so it's a different. Oh, I'll finally get this in. It's a different environment. So the best way I describe it, according to Ding Ding, is that working at an investment bank, working at a sell side, is like doing exams and tutorials and having essay stuff due. It's all peak stress. You've got an exam next week, you've got to study for that exam. You've got a client meeting, you've got your boss coming in, you've got this going on, then you've got to do this. It's all these series of events that have sort of stress peaks for you. But being an investor is a bit like writing a thesis. I've got a long term to make money, and if I don't make money, so when I start writing the thesis, I've got idea of what I want to do, and I'm learning the whole time, but I don't get stressed till the end of the year if I haven't made any money. And so it's an interesting change. I can go, if I want, I can play golf every morning, but then, I don't want, so to speak. But yeah, that's really exciting, and you learn. I'm very lucky at my age to be given this opportunity to keep learning. Otherwise, and the other difference is, the one thing about working in a bank or an investment bank or a big fund manager is there's lots of people. So you get lots of conversation, and in all those years in working at Goldman Sachs and BT, I only had an office a couple of times. I'm always sitting on a dealing desk, sitting next to people, and so you're constantly engaging with people. Now there's less people engagement, so there's less people. People are always trying to sell you something, so you become a lot more cynical. So, all right, up, yep.
What's your view on Indian rupee versus to the US dollar? What's your in 3 4 years, how do you think could be the upside or downside to the Indian currency depreciation?
India. It's easy to say that India's a big market, there's lots of potential, but it's extremely poor, it's extremely inefficient, and so it has a lot of reform to do. And Modi's done some reform, but it's hard to do reform. Reform's hard because it means that I decide that, okay, we're going to reform this university and everyone has to come to class wearing purple shirts. You think, well, that's easy. But then you don't want to wear a purple shirt because you haven't got any purple shirts because you have to go and buy purple shirts and that's going to cost you money. So I'm not wearing a purple shirt, so stuff him, I'm not going to do it. And so reform's always hard because it's going to cost someone some money. And India needs huge amounts of reform. And this is, go back to the China questions. this is the great thing, that China was prepared to do some of these reforms and has created this increase in GDP per capita. Now, India's done some of that, but it hasn't done enough. And so, I mean, maybe Modi wins the election, maybe there's a reform process, but reform is really difficult. So it's not just India. Other than the same-sex marriage vote, and so social, what is the last great financial reform that Australia did? I mean, if you can name it, you're better than me. We haven't done reform in this country for a long time. We've done some social reform, which is arguably more important, but what macro reform have we done? I mean, you're really looking back, and we've had some unbelievable, the great reforms of the Hawke-Keating government, the floating of the currency, the opening of the banking system, the creation of superannuation. They're in the Reform Hall of Fame, wherever that is in the world. And so it's hard. And then we haven't done any because you have a balance of power in the Senate, and so everyone votes to vested interest. And I mean, that's just politics. That's just the way it works. India's struggled with some of that reform, and this is maybe you argue that India should have a communist party, and but a dictatorial sort of but I mean, so I think the one thing about the Indian currency is it goes down because they run external deficits, and so over time, until you fix that, my bias is you'll get some strength in the short term and you'll think I'm an idiot, but my bias is it weakens over time because they don't reform and they're unable to fix the external borrowing issue.
So having a fund denominated in USD invested in Indian business environment.
Yeah.
4-year horizon, what's the good way to take my return?
So the question is dollar-based fund invested in Indian assets. Well, it's very liquid, so you just have to trade the currency around. So, because the stock market's there's been massive money go in this year, almost record money year to date. And so, I mean, it's the great hope. There's great hope for reform in Brazil. There's great hope for reform in South Africa. There's been some reform and probably not as much great hope, but some hope for reform in India. Trying to think where else in the world. And if these reforms come off, that's a 15 to 20% appreciation of the currency, let alone it could be a doubling of the equity market. So it's a big deal. And so you should be unhedged for the moment. But I mean, Modi, I guess, probably wins a slight coalition, and we'll see what happens after that. But if the reforms happen, I would stay unhedged, but watch it. Yep. Oh, sorry, yes. Oh, yeah, that's a question I got. Can the individual beat the big company? So historically, no. But it sort of depends. So the first thing is, the book I put up before, One Up on Wall Street, he talks about the fact that once Wall Street starts covering a company, it becomes a lot more difficult to make money. And the reason is because so much information is in the public domain. And especially now where no one gets any tips, it's even harder. And so, in theory, yes. But if you're trading well capitalised and covered stocks, it's going to be, what's your skill set trading BHP, for example, versus someone else's? It's probably not quite as good. So on average, the better golfer will, only because they do it professionally for a living. So the professional golfer will beat the amateur golfer given the same set of information. So that's difficult. But things get over-covered, so it's possible. But it's difficult. But information is now more freely available, but it's still not as freely available because you have to pay for it. So to get the same information that I get, you have to spend literally tens of thousands of dollars, and my information isn't as good as some other people's. And so are you prepared to do that? And if you're not, then you're going to be at a slight disadvantage. So probably not.
So you recommend a mutual fund or something?
No, I recommend that you put a portion of your money with a professional investor. And a portion of the money you should speculate wildly on. Because you're all young, now I don't know all your personal situations obviously, because at some point in time you need to have your money at a low cost. Fees matter, says me. You don't even know what our fees are. But so low cost, index-based, Vanguard, Aussie Super, that sort of fund. I don't know. The other funds will kill me for not saying their names. And costs matter. Costs matter. And then keep a portion of it and have some fun with it. Like you could lose it all, but just keep a little bit and say, maybe I'll trade crypto because that thing bounces around 5%, or maybe I'll trade a few equities around myself and see how I go and see if I like it. Or maybe I'll do some private equity and maybe I'll get lucky and my friend will start a company and I'll put some private equity in. So don't put it all in. You're too young to be all in conservative risk. And you'll all get jobs and you'll all do well. So keep a portion, because you'll learn from that. And you might learn that you hate it. Like, this is the dumbest thing. That idiot spoke to us for 2 hours. That's it. He did nothing. But you might like it. And then you put all your money in. But that would be my advice. Probably don't bet on the horses with it all. But if you want to, people,
Yeah. In practice, when you make buy or sell decision on certain currency, do you rely more on the technical approach or fundamental approach?
Technical. Yeah.
How about equity?
Same. So I only trade indexes, and so because the fundamental decision I know what the fundamentals are, but the day-to-day, because I'm a leveraged investor, I have to get the timing right, and that has to come from price action. And price action can change my fundamental views. There's the famous macro speculator George Soros wrote a book. I think he called it Reflexivity, and his basic view was that market opinion eventually changes to the price forces. Price forces market opinion, not market opinion forces price. So the price goes down long enough, everyone gets bearish. And then eventually that reverses. But that's the sort of, the fundamentals are one thing, and then of course there's a billion commentators all telling you something different. So it's sort of trying to keep that out of your head. But the price action is the price action. It's just on a screen, it's a line, and there's a lot of different technical things I look at. But I think that's how you enter or exit trades. Got 5, 4, 3, 2. Careful, you buy 1. That's it. All right. Thank you very much. And none of this will be in the exam.
Or perhaps it would be.
Good luck. Remember, be a doer of deeds. You're all talented enough. You're all good enough. Work on your resume, work on the interview skills, and just apply whatever it is you want to do. And good luck. I wish you all the best.
So thank you very, very much for 2 full hours. And on behalf of our school, there is a bottle of wine for you to relax tonight, and also our school T-shirt.
Oh, thank you
Thank you
very
very
much.
I'm sure all of us are really appreciative of everything that you have shared. And I guess it's time for a 10-minute break right now, but please do come back because I do want to go on with our regular lecture. All right. All right, so thank you very, very much. Really appreciate it. Oh.
That's okay. Ah,
So I guess it's a good time. You have an
I'll get one.
Okay. I think the best way to go out is to go out there. I'll just take
I can find it's surrounded.
Yeah.
Okay.
Thank you for
That's all right.
yeah, thank you. Okay, all right, so thank you very much for your participation in the previous guest lecture. That was really, really good. And in a week's time, on May 8th, I believe, or the 9th, the guest lecturer from GIC, the biggest sovereign wealth fund, well, one of the biggest sovereign wealth fund in the world, which is that of Singapore's, is going to come along. So he's going to have an extra chat session like today when we have organized for a smaller group of people, and hopefully a lot more people can come and participate. And then we're going to have a session like this then. So if you have any questions, think about those, think about the things that you can ask, because it's very rare that you can actually speak one-on-one with somebody who is so experienced in the industry and who is actually really willing to share their knowledge with you. So I would highly encourage that you prepare for that. And great, so let's go back onto matters at hand. So the mid-semester solution has been posted on Waddle. You may be able to find that as of noon. So all of the answer keys, as well as where the answers could be found, plus brief or detailed explanations, are found on the answer key. And so you can find those on Waddle. And then the other thing I want to talk about is the class distribution that you may be all concerned about. So I think that, as I have said on the course announcement, it has been a really good job overall. So that was really well done. And in terms of the class distribution, it compares really, really well with the typical RS Fast course, right? So that is the distribution for the typical RS Fast course here. And this is what our performance is. So if we are looking at a raw score, what I would not do is to look at what you have got, but to look at where you are with respect to the rest of the class, because that will give you suggestions as to whether you are going to get, HDD credit pass or hopefully none in the N category. And so in this case, if this was the distribution in the final exam, I would be more than happy to hand it into the school office, because as I promised, if everybody got HDs and Ds, I'm happy to defend your performance. You do not have to be worried that I'm going to downgrade or scale downwards your raw mark, right? So all of the mark that you see here is in terms of percentage. That is divided by 45. And 75, thank you. That is divided by 75. And so everybody above 80 would get an HD. And the people in the bracket between 70 to 80, the typical bracket, would get an D credit. About roughly 20% will get credit, and then the rest pass, and then after that. And 9 people got grades above 100%, which means that they have at least gotten some of the bonus marks to push them up to beyond 75. And that is the more detailed distribution. So there are a total of 366 students who took the mid-semester exam. So the average mark is 68%, and the median, that means 50% of the class got at least 70% and higher, right? And so the minimum grade was 12%, while the maximum grade was 105%. In the first quartile, that means about 75% and more people got more than the, what is the grade for? That's for pass? Yes, for the pass mark, right? 57%. And then 25% of the class got above the HD mark. So I'm happy with that. if that was the final distribution in the final exam, and then the course grade, then I'm going to hand that in. So you do not have to be worried, again, to think that I'm going to have to press this down. So I'm not going to do that. Any questions? Any concerns? Yes? Oh yeah, I have posted individual results as of yesterday. Yes. So as soon as I posted the individual results, I posted it on the course announcement. Yeah. Oh, right. Okay, so the question is with respect to the weighting of the mid-semester exam on Waddle. Forget about that. Just ignore that part. The weighting is 34%, right, as on your course outline. The thing that you should take attention on is on the actual raw mark that you got, between 0 and 75. Yeah, and again, it's redeemable, right? So if you got a better mark on the final exam, then the 34% is going to be shifted to your final mark. Right? So for those of you who think that you are going to strive for better grades on the final exam, please do so. Right? But at least you have the cushion to know that, 50% of you done pretty well. Other questions? Oh, and finally, if you go on to the course announcement, there is going to be a script book review session this Friday from 2:30 to 4:30. That is going to be in the glass room on the 4th floor of 26C, which is just down the hall from my office. That's going to be the only available script book viewing session. So if you want to take a look at your script book, please take the opportunity to do so. Other questions? Right? Yes, this Friday, April